Here is a number that ought to stop you cold. Between 400 and 600 million euro. That is the precise sum, confirmed not by a think tank with an agenda, not by a political party with a manifesto, but by the revenue commissioners themselves, delivered in testimony to the Public Accounts Committee, that Irish taxpayers are simply leaving uncollected, not stolen, not confiscated, simply abandoned, walked away from, handed back to the state with a polite bow and a shrug of ignorance. And the great uncomfortable irony in all of this is that the people most likely to be handing it back are the people who can least afford the indulgence of ignorance, the high earners, the professionals, the builders and the strivers who spend 60 hours a week generating income and perhaps 60 minutes a year thinking about what happens to it afterward. This is not a conversation about tax evasion. Let us be absolutely clear on that point from the very first breath, because nothing poisons a legitimate discussion faster than the suggestion of illegality. Every single mechanism we are going to explore today sits on the statute books of this republic, placed there deliberately by elected legislators for the express purpose of being used. The question is not whether these reliefs are available. The question, and it is a question that should genuinely disturb anyone who takes their own financial future seriously, is why so few people are using them. Begin where the arithmetic is most dramatically in your favor. Begin with the pension. If you are a top-rate taxpayer in Ireland today, you are paying 40% income tax on every euro you earn above the standard rate cutoff point. This is not opinion, it is the law. And here's what that law also says, buried in the same statutes that take your money. When you contribute to an approved pension scheme, the state gives that 40% back. Every 100 euro you put in costs you 60 euro from your take-home pay. The state funds the other 40. And that is before a single cent of investment growth has occurred, before any stock market movement, before any interest rate movement, before the universe has had the opportunity to do a single thing in your favor. The Irish government has already handed you a guaranteed, legislated return of 66% on your net outlay. 66%. There is no product on any regulated exchange in the world that begins to approach that figure with anything resembling certainty. Let us make this concrete enough to feel real, because abstraction is the enemy of action. Suppose you contribute 500 euro a month to your pension. At the top tax rate, that 500 euro costs you 300 euro out of your actual pocket. The government absorbs the remaining 200. Over 5 years, you have committed 30,000 euro worth of contributions, but it has cost you 18,000 from your real money. Assume zero growth, not a bull market, not clever investment decisions, just zero. The tax relief alone, the sheer mechanical operation of the relief, has delivered an annualized return of more than 18% per year on your actual cash outlay. 18%, guaranteed by the state. Now consider what that same 300 euro a month is doing if you are directing it instead toward the accelerated repayment of your mortgage. This is an extraordinarily common choice among Irish professionals, and it is not irrational. It is simply arithmetically inferior in almost every comparison. At a current variable mortgage rate of around 4%, you are earning a guaranteed 4% return, tax-free, on those accelerated payments. 4% is not nothing. 4% is respectable. 4% is simply not 18%. And when you lay those two numbers alongside each other, genuinely lay them alongside each other, on paper, in cold daylight, the choice becomes not a financial question, but almost a philosophical one. Why would a rational person accept 4 when 18 is available? And then there is cryptocurrency, a subject that provokes either evangelical fervor or contemptuous dismissal, depending on which side of the generational divide you inhabit. For our purposes, we need not debate its merits as an asset class. We need only do the arithmetic. If you invest that same 300 euro a month in crypto rather than a pension, you are not only investing 300 instead of 500, you are also exposing every euro of profit to capital gains tax at 33%. For cryptocurrency to deliver the same net outcome as a pension contribution with zero growth, it would need to generate a gross annual return of 25%. Every year, consistently. In one of the most volatile and unpredictable markets that human civilization has yet devised. 25% just to break even with doing nothing except using a relief that already exists. 3 choices. One guarantees you 18% a year by legislative fiat. One guarantees you 4% with admirable reliability. One demands you outperform almost every professional fund manager on earth merely to keep pace. Which one would a person of clear reasoning select? If you found this valuable, if this is the kind of thinking about money that nobody ever sat down and walked you through, then consider subscribing right now, because what follows is going to get considerably more uncomfortable and considerably more important. The second great mistake that Irish high earners make is also, in a certain sense, the most forgivable. It arises not from laziness or indifference, but from a misunderstanding of professional roles, a confusion about who is responsible for what, and a consequent assumption that someone else is taking care of something that is, in reality, nobody's job at all. Most people in Ireland who engage a professional accountant believe at some level that they have arranged for their tax affairs to be managed. They have not. They have arranged for their tax affairs to be reported. These are not the same thing. They are not even cousins of the same thing. The distinction between them is the difference between a doctor who records your symptoms and a doctor who changes your behavior to prevent the disease from occurring. Your accountant, for the overwhelming majority of engagements, is the former, skilled at the former, trained for the former, legally obligated in the former direction. When you sit across from your accountant and the conversation begins, show me last year's invoices, provide your bank statements, account for your expenses, you are engaged in an exercise of compliance. Compliance is backward-looking by its very nature. The past is fixed. You cannot change it. You can only account for it, accurately and on time, in order to avoid penalties that are themselves a form of financial self-destruction. Tax planning, genuine tax planning, is a forward-looking discipline. It requires you to look at the road ahead and identify, with as much precision as possible, what financial events are likely to occur, and then ask which of your current behaviors you can alter today so that, when those events arrive, they arrive with the lightest possible tax consequence. Retirement relief, entrepreneurial relief, agricultural relief, business asset relief for the orderly transfer of enterprises between generations. These reliefs are not secrets. You could find them on the Revenue website this afternoon, but knowing that a relief exists and knowing whether you qualify for it are entirely separate matters. And knowing whether you will qualify for it on the day you need it, having prosecuted a deliberate plan over years or decades to meet every qualifying criterion, is the thing that separates a person who gets the relief from a person who reads about it in retrospect and wonders why nobody told them in time. The qualifying criteria are frequently demanding. Some reliefs require that you have owned the relevant asset for a specified minimum period. Some require that you have reached a specific age. Some require that the nature of the asset itself meets narrow technical definitions that are easy to satisfy if you know about them in advance and impossible to retrofit after the fact. This is why the planning has to happen in the present tense, not last year, now. The third error is one that carries perhaps the most immediate and quantifiable cost. It is the failure to operate through a limited liability company when your income clearly warrants one. And the people making this error are not struggling. They are successful. They are earning more than they need for ordinary living expenses, more than the mortgage, the groceries, the family holiday, the car. They are generating a surplus, and that surplus is disappearing into the highest personal tax rates in the European Union instead of being structured to grow. The limited company does precisely two essential things that sole tradership cannot. First, it limits your liability. This sounds administrative until you consider that as a sole trader, every asset you own, your home, your pension fund, your savings, your car, is exposed to the commercial risks of your business activity. The law makes no distinction between you and your enterprise. A single creditor dispute, a single commercial misfortune, can reach through your business and into the most personal corners of your financial life. The limited company places a legal wall between those two worlds. Second, and this is where the arithmetic becomes compelling again, the limited company opens doors that are simply bolted shut for sole traders. The small benefit exemption, for example. From January 2025, this scheme allows an employer to provide up to €1,500 per year to an employee in tax-free non-cash benefits, free of income tax, free of PRSI, free of USC. As a sole trader, you are not an employee. You cannot access this exemption. Become a director and employee of your own limited company, and €1,500 a year arrives into your life that did not exist yesterday, taxed at precisely zero. The pension contribution limits within a company structure are substantially greater than those available to self-employed individuals operating outside one. The ability to employ family members, a spouse who is genuinely contributing to the business, children working during holidays, becomes legitimate and tax efficient where it was previously unavailable or inefficient. Yes, the accountancy costs of running a limited company are higher than those of a sole tradership. This is frequently offered as the decisive objection, and it is frequently wrong. A cost is not an argument against something. A cost is one side of a ledger. The other side contains the benefits. When you place the modest additional cost of limited company compliance beside the accumulation of exemptions, protections, and reliefs that the structure makes available, the argument against incorporation becomes, in most cases, arithmetically indefensible. The professional who tells you it is too expensive to incorporate is telling you something accurate about one line item while declining to discuss the full page. There is a tax in the Irish system that manages to be, simultaneously, one of the most legally straightforward and one of the most emotionally devastating. Capital acquisitions tax, the inheritance and gift tax, charged at 33% on the value of assets above certain thresholds, applied to money that has already been taxed, often multiple times, during the lifetime of the person who earned it. In 2025, the Irish state collected €1.2 billion from this single source. That is the largest amount it has ever collected in a single year, and by every reasonable projection, the number will only grow. Because the wealth accumulated by Irish households over the past 2 decades is unprecedented in this nation's history, and because the thresholds, while improved in recent budgets, remain inadequate to shelter the full value of what families have built. Let us be precise about the current numbers, because precision matters when the stakes are this high. The Group A threshold, applying to children inheriting from a parent, currently stands at €400,000. The Group B threshold, covering siblings, nieces, nephews, grandchildren, is €40,000. The Group C threshold, for everyone else, is €20,000. Everything above those figures is taxed at 33 cents in every euro. In a country where the average Dublin property now regularly exceeds €450,000, a straightforward parent-to-child inheritance of a family home can breach the threshold with a single asset, generating a tax bill on what is, in every meaningful sense, a family's life's work. The failure to plan for this is not unique to Ireland, but it is particularly acute here. We are told that 73% of Irish adults do not have a valid will, not a sophisticated succession plan, not a family trust structure, not even a will. The document that any solicitor can prepare, that requires nothing more exotic than clarity of intention and a functioning pen, is absent from the estate planning of nearly 3 in 4 Irish adults. A guarantee of no plan is a guarantee of maximum taxation and maximum family conflict. These two outcomes are almost mathematically certain in its absence. Consider what proper planning actually looks like in practice. Agricultural relief can reduce the taxable value of farmland by up to 90%, but only for beneficiaries who qualify as farmers under revenue's definition, meaning at least 80% of their assets after the inheritance consist of agricultural property. Business asset relief offers comparable reductions for qualifying businesses. Dwelling house exemption can shelter a family home from CAT entirely, but the conditions are strict and must be met precisely. A will written without awareness of which beneficiaries qualify for which reliefs is not merely imperfect. It can actively cause harm by directing assets to people whose receipt of them triggers tax that could legally have been avoided by directing those same assets to someone else. This is not theoretical. It happens in Irish families constantly. A farmer divides land equally among 6 children, believing fairness requires equal distribution. The legal reality is that 3 of those children may qualify for agricultural relief, and 3 may not, meaning a substantial portion of the estate that could have transferred tax-free is instead handed to revenue at 33 cents on the euro. The solution, directing the agricultural assets to the 3 who qualify and compensating the others with different assets, produces the same equitable outcome for the family while eliminating the preventable tax. But nobody explains this at the solicitor's office, because the solicitor's job is to record your instructions, not to optimize their tax consequences. And finally, the 5th and perhaps most pernicious mistake, because it masquerades as virtue. It is the mistake of reviewing once and considering the work finished. The person who had a financial plan drawn up 2 or 3 years ago and has not returned to it since is not being prudent. They are being static in a world that is relentlessly dynamic. Their income has almost certainly changed. The tax rules have changed. The SBE threshold alone has moved from €1,000 to €1,500 in a single budget cycle. Property values have changed. Mortgage loan-to-value ratios have shifted. Investment opportunities that were financially inaccessible at one income level have become available at another. The Employment Incentive and Investment Scheme, for example, offers income tax relief on qualifying investments in Irish companies, a relief invisible to someone who could not afford it 3 years ago, but entirely available to that same person today. Wealth accumulation is not a destination, it is a discipline. It requires periodic, honest, informed attention. Not the 60-hour weekly attention that maximizes income, but guarantees you must work every remaining day of your life, but the structured, strategic attention that asks, at regular intervals, whether the plan still fits the circumstances and whether the opportunities available today are being used. The people who build lasting wealth in Ireland are not, in the main, the people who earn the most. They are the people who pay the most sustained and intelligent attention to what they earn, who engage genuinely with the reliefs, the structures, and the planning that the law has made available, and who revisit that engagement as their circumstances evolve. The revenue commissioners have told the Public Accounts Committee in plain language that between 400 and 600 million euro in legitimate reliefs goes unclaimed by Irish taxpayers every year. Every single euro of that is legal. Every single euro of it was placed in the tax code deliberately, and every single euro of it belongs by right to the people who are unknowingly handing it back. The question worth sitting with, when this is over, is a simple one. How much of your share are you leaving behind? And what are you prepared to do differently starting now? Leave your answer in the comments below. Tell us which of these 5 mistakes you think is most common or most costly. The conversation that follows is often more valuable than the content that starts it. And remember, this is for education and discussion only, not personal financial advice. I'm sharing a way to think through the history, the market, and the ownership questions so you can make your own decisions with your own money and your own risk tolerance.